all or none, ANON an order that must be filled in its entirety or not at all. American option. An American option is a style of options contract that allows holders to exercise their rights at any time before and including the expiration date. An American-style option allows investors to capture profit as soon as the stock price moves favorably. Arbitrage. An important principle in options pricing is called put-call parity. This parity states that the value of a call option, at a specified strike price, implies a particular fair value for the corresponding put option, and vice versa. Thus, the price of a call and put should always hold a price relationship between one another. The theory behind this pricing relationship relies on the possible arbitrage opportunity that would result if there is a divergence between the value of calls and puts with the same strike price and expiration date. Knowing how these trades work can give you a better feel for how put options, call options, and the underlying stocks intermingle. Asian option. An Asian option is an option type where the payoff depends on the average price of the underlying asset over a certain period of time as opposed to standard options, American and European, where the payoff depends on the price of the underlying asset at a specific point in time, maturity. These options allow the buyer to purchase, or sell, the underlying asset at the average price instead of the spot price. Assignment. An option assignment represents the seller's obligation to fulfill the terms of the contract by either selling or buying the underlying security at the exercise price. This obligation is triggered when the buyer of an option contract exercises their right to buy or sell the underlying security. At the forward, describes a situation when the future price of an option is equal to the underlying asset's current market price. At the money, ATM, describes a situation when the strike price of an option is equal to the underlying asset's current market price. It is a concept of moneyness, which describes the position between the strike price of an option and the market price of the underlying asset. Automatic exercise. With automatic exercise, a trader or investor who forgets about the date, or who is otherwise unable to manually instruct their broker or clearing firm to exercise their in-the-money options, will have the benefit of having their profitable contracts taken care of on their behalf. Average price option. A traded average price option is an over-the-counter, OTC, product. Its payoff has a basis on the average price of the underlying asset over a specified time frame. The determination of the average price is at contract creation. Backspread. A backspread is a type of option trading plan in which a trader buys more call or put options than they sell. The backspread trading plan can focus on either call options or put options on a specific underlying investment. Backward. A futures market where the long-term delivery months trade at a discount to the short-term delivery months. Barrier option. Barrier options are a type of exotic option in which payout depends on whether the option has reached or exceeded a predetermined barrier price. Barrier options offer cheaper premiums as compared to standard options and are also used to hedge positions. Bear spread. A bear spread is an options strategy used when one is mildly bearish and wants to maximize profit while minimizing losses. Bermuda option. A Bermuda option is a type of exotic options contract that can only be exercised on predetermined dates, often on one day each month. Binary option. A binary option is an option that either pays a fixed monetary amount or nothing at all, depending on whether it expires in the money. Box. A box spread, or long box, is an options arbitrage strategy that combines buying a bull call spread with a matching bear put spread. A box spread can be thought of as two vertical spreads that each has the same strike prices and expiration dates. Bull spread. A bull call spread consists of one long call with a lower strike price and one short call with a higher strike price. Both calls have the same underlying stock and the same expiration date. A bull call spread is established for a net debit, or net cost, and profits as the underlying stock rises in price. Butterfly. Butterfly spreads use 4 option contracts with the same expiration but 3 different strike prices. A higher strike price, an at-the-money strike price, and a lower strike price. The options with the higher and lower strike prices are the same distance from the at-the-money options. Buy right. A buy right is an options trading strategy where an investor buys a security, usually a stock, with options available on it, and simultaneously writes, sells, a call option on that security. The purpose is to generate income from option premiums. Cabinet bid, a method of allowing someone to sell out of the money options, equals options which have no value, for a very small amount of money. Calendar spread, a calendar spread is a low-risk, directionally neutral options strategy that profits from the passage of time and / or an increase in implied volatility. Call option, a call option is a contract that gives the option buyer the right to buy an underlying asset at a specified price within a specific time period. Cap, a capped option limits, or caps, the maximum profit for the holder by automatically exercising when the underlying asset reaches a specified price. Charm, or delta decay, is the rate at which the delta of an option or warrant changes with respect to time. Charm refers to the second-order derivative of an option's value, once to time and once to delta. It is also the derivative of theta, which measures the time decay of an option's value. Chooser option, a chooser option is an option contract that allows the holder to decide whether it is to be a call or put prior to the expiration date. Christmas tree, a Christmas tree is an options spread strategy that involves 6 call, or put, options, buying 1 ATM call, put, selling 3x calls, puts, 2 strikes out of the money and then buy 2x more call, put, 3 strikes out of the money. Class, an option class refers to all the call options or all the put options listed on an exchange for a particular underlying asset. Clearinghouse, the clearinghouse validates and finalizes the transaction, ensuring that both the buyer and the seller honor their contractual obligations. Clearing member, a clearing member trade agreement, CMTA, allows investors to enter derivative trades with multiple brokers and later clear all trades with one broker. Collar, a collar, commonly known as a hedge wrapper, is an options strategy implemented to protect against large losses, but it also limits large gains. Collar is the rate at which the gamma of an option will change over time and is the third-order derivative of an option's value. Combination, a combination generally refers to an options trading strategy that involves the purchase or sale of multiple calls and puts on the same asset. Compound option, a compound option is an option for which the underlying asset is another option, thus 2 strike prices and 2 exercise dates. Condor, a Condor spread is a non-directional options strategy that limits both gains and losses while seeking to profit from either low or high volatility. Contango is a situation in which the futures price of a commodity is above the spot price. Contingency order, a contingency order is one that is executed only when certain conditions of the security being traded, or another security, have been fulfilled. Conversion, for a forward conversion, you buy stock and then hedge it with a synthetic short position. A reverse conversion is the inverse trade. Either way, you end up with a trade that should produce a fixed return regardless of underlying price movement. Covered right, writing a covered call means you're selling someone else the right to purchase a stock that you already own, at a specific price, within a specified time frame. Because one option contract usually represents 100 shares, to run this strategy, you must own at least 100 shares for every call contract you plan to sell. Cylinder, the term cylinder refers to transactions that do not require an initial or ongoing cash outlay, typically in the context of derivative transactions. Delta is the ratio comparing the change in the price of the underlying asset to the corresponding change in the price of a derivative. Delta neutral is a portfolio strategy consisting of positions with offsetting positive and negative deltas so that the overall position of delta is 0. Diagonal roll, a diagonal spread is an options strategy using a long and short position in either calls or puts with different strike prices and expiration dates. Diagonal spread, a diagonal spread is an options strategy using a long and short position in either calls or puts with different strike prices and expiration dates. Digital option, a digital option is a form of option that provides traders with the opportunity of a fixed payout when the market price of the underlying asset exceeds the strike price. Dragonfly, a long, short, straddle, together with two short, long, strangles at the same exercise price, where all options expire at the same time and have the same underlying contract. The exercise price of the straddle will usually fall as close as possible to the midpoint between the exercise prices of the strangles. Dynamic hedging. Dynamic hedging is an approach used by options traders to hedge their options positions. Because this approach involves adjusting the hedge as the underlying asset moves, it is referred to as dynamic hedging. Efficiency, a number that represents the relative risk and reward of a potential option strategy. The risk and reward are typically represented by the total gamma, theta, and vega of the strategy. The efficiency is generated by dividing one sensitivity by another. Elasticity. Elasticity, the leverage of an option position, measures the percent change in an option price per 1% change in the underlying asset price. Eurocurrency. The Eurocurrency market is the money market in which currency held in banks outside of the country where it is legal tender is borrowed and lent by banks. Eurocurrency rate, the interest rate paid on currency deposited in bank outside the currency's home country. European option. A European option can only be exercised on its maturity date, unlike an American option, resulting in lower premiums. Exchange option. An option to exchange one asset for another asset. Ex-Dividend. Ex-Dividend describes a stock that is trading without the value of the next dividend payment. The ex-dividend date or ex-date is the day the stock starts trading without the value of its next dividend payment. Typically, the ex-dividend date for a stock is 1 business day before the record date, meaning that an investor who buys the stock on its ex-dividend date or later will not be eligible to receive the declared dividend. Rather, the dividend payment is made to whoever owned the stock the day before the ex-dividend date. Exercise. Exercise means to put into effect the right to buy or sell the underlying financial instrument specified in an options contract. Exercise price. The exercise price is the strike price, or the price at which the underlying security can be bought or sold when trading options. Expiration. Expiry. The expiration date of a derivative is the last day that an options or futures contract is valid. Exotic option. Exotic options are options contracts that differ from traditional options in their payment structures, expiration dates, and strike prices. Extrinsic value. Extrinsic value is the difference between an option's market price and its intrinsic value. Fair value. Fair value can refer to the agreed price between buyer and seller or the estimated worth of assets and liabilities. Fill or kill. FOC. Fill or kill is a type of equity order that requires immediate and complete execution of a trade or its cancellation, and is typical of large orders. Flex option. Flexible exchange options allow both the writer and purchaser to negotiate various terms, such as exercise style, strike price, and expiration. Floor. An interest rate floor is a derivative contract in which the buyer receives payments at the end of each period in which the interest rate is below the agreed strike price. Forward contract. A forward contract is a customized contract between two parties to buy or sell an asset at a specified price on a future date. Forward price. The predetermined delivery price of a forward contract, as agreed on and calculated by the buyer and seller. Forward start option. A forward start option is an exotic option that is bought and paid for now but becomes active later with a strike price determined at that time. Front spread. The front ratio spread strategy works by financing the purchase of a long option through the sale of a greater number of OTM options. These spreads are executed for a small credit and eliminates risk to the OTM side of the trade. Fugit. Fugit is the amount of time that an investor believes is left until it would no longer be beneficial to exercise an option early. Futures contract. A futures contract is a standardized agreement to buy or sell the underlying commodity or other asset at a specific price at a future date. Futures type settlement. A settlement procedure used by commodity exchanges whereby an initial margin deposit is made but under which no immediate cash payment is made by the buyer or seller. Cash settlement takes place at the end of each trading day based on the difference between the original trade price or the previous day's settlement price. Gamma. Gamma describes the rate of change of an option's delta with respect to the underlying asset's price and is used to gauge price movement of an option. Good till cancelled. A good till cancelled (GTC) order is a buy or sell order that remains active until it is either executed or until the investor cancels it. Guts. A gut spread is an option strategy created by buying or selling an in-the-money put at the same time as an in-the-money call. Haircut. A haircut is the percentage difference between what an asset is worth relative to how much a lender will recognize of that value as collateral. Hedge ratio. The hedge ratio compares the value of a position protected through the use of a hedge with the size of the entire position itself. Hedger. A trader who enters the market with the specific intent of protecting an existing position in an underlying contract. Horizontal spread. Horizontal spread is a simultaneous long and short derivative position on the same underlying asset and strike price but with a different expiration. Immediate or cancel. An immediate or cancel order, IOC, tries to fill as much of an order as possible in the next few seconds and then cancels any balance. Implied volatility. Implied volatility, 4, is the market's forecast of a likely movement in a security's price. It is often used to determine trading strategies and to set prices for option contracts. In option, a knock-in option begins to function as a normal option, knocks in, only once a certain price level is reached prior to expiration. In price, the price at which the underlying instrument must trade before an in option becomes effective. In the money, IDM, means that an option has value, or its strike price is favorable compared to the prevailing market price of the underlying asset. Index arbitrage. Index arbitrage is a trading strategy that attempts to profit from the differences between actual and theoretical prices of a stock market index. Intermarket spread. An intermarket spread involves purchasing long futures in one market and selling short futures of a related commodity with the same expiration. Intrinsic value. Intrinsic value is the perceived or calculated value of an asset, investment, or company and is used in fundamental analysis in the options markets. Iron butterfly. An iron butterfly is an options strategy created with 4 options designed to profit from the lack of movement in the underlying asset. Iron condor. An iron condor is an options strategy consisting of 2 puts, 1 long and 1 short, and 2 calls, 1 long and 1 short, and 4 strike prices, all with the same expiration date. The iron condor earns the maximum profit when the underlying asset closes between the middle strike prices at expiration. Jelly roll. A jelly roll, or simply a roll, is an options trading strategy that captures the cost of carry of the underlying asset while remaining otherwise neutral. It is often used to take a position on dividends or interest rates, or to profit from mispriced calendar spreads. Kappa. Kappa measures how an option's price will react to a change in implied volatility, even if the price of the underlying stays the same. Knock-in option. A knock-in option begins to function as a normal option, knocks in, only once a certain price level is reached prior to expiration. Knockout option. A knockout option is an options contract that will become worthless if the investment reaches a specific price. Ladder. A ladder option locks in partial gains once the underlying asset reaches predetermined price levels, even if it falls back down below these levels. Lambda. Lambda is the percentage change in an option contract's price to the percentage change in the price of the underlying security. LEAPs, long-term equity anticipation securities, LEAPs, are options contracts with expiration dates that are longer than 1 year. Leg. A leg is one component of a derivatives trading strategy in which a trader combines multiple options contracts or multiple futures contracts. Leverage value, see elasticity. Limit, the maximum allowable price movement over some time period for an exchange-traded contract. Limit order. A limit order is an order to buy or sell a security at a specific price. A buy limit order can only be executed at the limit price or lower, and a sell limit order can only be executed at the limit price or higher. Local, an independent trader on a commodity exchange. Locals perform functions like market makers on stock and stock options exchanges. Locked market. In finance, the term locked market refers to a situation in which the bid and ask price for an exchange-listed security are identical. Long, a position resulting from the purchase of a contract. The term is also used to describe a position that will theoretically increase, decrease, in value should the price of the underlying contract rise, fall. Note that a long, short, put position is a short, long, market position. Long premium, a position that will theoretically increase in value should the underlying contract make a large or swift move in either direction. The position will theoretically decrease in value should the underlying market fail to move or move very slowly. The term may also refer to a position that will increase in value should implied volatility rise. Long ratio spread. A long ratio call spread combines one short call and two long calls of the same expiration but with a higher strike. This strategy is essentially a bear call spread in a long call, where the strike of the long call is equal to the upper strike of the bear call spread. Lookback option. A lookback option allows the holder to exercise an option at the most beneficial price of the underlying asset, over the life of the option. Margin. Margin is the money borrowed from a broker to purchase an investment and is the difference between the total value of the investment and the loan amount. Market if touched. A market if touched, MIT, order is a conditional order that becomes a market order when a security reaches a specified price.
Market on close. A market on close, MOC, order is a non-limit order that is executed as close to the end of the market day as possible. Market order. A market order is an instruction to a broker to buy or sell a stock or other asset immediately at the best available current price. Mark to market, MTM, is a method of measuring the fair value of accounts that can fluctuate over time, such as assets and liabilities. Married put. A married put is an options strategy where an investor, holding a long position in a stock, buys a put on the stock to mimic a call option. Mid-Atlantic option, an option contract that may only be exercised on certain days. For example, if one buys a Mid-Atlantic call giving him/her the right to buy shares in X expiring on the final Friday in March, the call may only be exercised on certain days, usually one day per month. The term Mid-Atlantic comes from the fact that it combines features of a European option, which may only be exercised on the expiration date, and an American option, which may be exercised at any time. A Mid-Atlantic option is also called a Bermudan option. Mid-curve option. Mid-curves are options on Euro-dollar futures. However, their underlying futures contract expires later than the option does. This provides the ability to trade an option that expires in the short term but reference a futures contract that does not expire for up to a year or more. Naked. A naked option is created when the option seller does not currently own any, or enough, of the underlying security to meet their potential obligation. Neutral spread. Neutral describes a position taken in a market that is neither bullish nor bearish. Not held. A not held order gives a broker the time and price discretion to seek the best price available. The broker is not held responsible for any potential losses or missed opportunities that result from their best efforts. A held order, in contrast, requires immediate execution. Omega. Omega is an options Greek that measures the percentage change in an option's value with respect to the percentage change in the underlying price. One cancels the other. A one cancels the other order is a pair of orders stipulating that if one order executes, then the other order is automatically cancelled. Order book official. An order book official is the trading floor participant responsible for maintaining a list of public orders within a specific option class. Out of the money. An out of the money, OTM, option has no intrinsic value, but only possesses extrinsic or time value. OTM options are less expensive than in the money options. Out option. A knockout option is an option that has a built-in mechanism to expire worthless if the underlying asset reaches a specified price level. Out price. The price at which the underlying instrument must trade before an out option is deemed to have expired. Out trade. An out trade is a trade that cannot be placed by a clearinghouse because the trade data submitted by the counterparties is contradictory. Overwrite. Overwriting is a strategy to sell options that are overpriced under the assumption that the options won't get exercised. Parity. Parity price is a term used to explain when two assets are equal in value. Phi, also rho, refers to an option's or book of options, risk exposure to changes in interest rates. Pin risk. Pin risk is the uncertainty an options contract writer faces when the underlying asset price closes at or very near the strike price at expiration. Portfolio insurance. Portfolio insurance refers to hedging a portfolio through short selling, and it can also refer to brokerage insurance. Position. A position is the amount of a security, commodity, or currency that is owned, or sold short, by an individual, dealer, institution, or other entity. Position limit. A position limit is a preset level of ownership that limits the number of shares or derivative contracts that a trader, or affiliated group, may own. Premium. Premium is the total cost of an option, or the difference between the higher price paid for a fixed income security and the security's face amount at issue. Program trading. Program trading refers to the use of computer-generated algorithms to make trades in large volumes and sometimes with great frequency. Put option. A put option grants the right to the owner to sell some amount of the underlying security at a specified price, on or before the option expires. Range forward. A range forward contract is a zero-cost forward contract that creates a range of exercise prices through two derivative market positions. Ratchet option. A cliquet option or ratchet option is an exotic option consisting of a series of consecutive forward start options. The first is active immediately. Ratio spread. A ratio spread is a neutral options strategy in which an investor simultaneously holds an unequal number of long and short positions in a specific ratio. Ratio right. The sale of multiple options against an existing position in an underlying contract. Reverse conversion. A reverse conversion is a form of arbitrage that enables options traders to profit from an overpriced put option no matter what the underlying does. Row. Row refers to an options, or book of options, risk exposure to changes in interest rates. Risk reversal. A risk reversal is an options strategy used primarily for hedging purposes. Roll. A jelly roll, or simply a roll, is an options trading strategy that captures the cost of carry of the underlying asset while remaining otherwise neutral. It is often used to take a position on dividends or interest rates, or to profit from mispriced calendar spreads. Scalper. Scalpers enter and exit trades quickly, usually within seconds, placing large trades in the hopes of profiting from small price changes. Second generation option. A breed of options that bear non-standard features/elements, as opposed to vanilla options, plain vanilla options. Serial option. A serial option is a short-term option on a futures contract that trades for the months when the underlying futures contract is not listed for sale. Series. An option series refers to a grouping of options on an underlying security with the same specified strike price and the same expiration month. However, call and put options are parts of separate series. Short. Short selling occurs when an investor borrows a security, sells it on the open market, and expects to buy it back later for less money. Short premium. A position that will theoretically increase in value should the underlying contract fail to move or move very slowly. The position will theoretically decrease in value should the underlying market make a large or swift move in either direction. The term may also refer to a position that will increase in value should implied volatility fall. Short ratio spread. A spread where more options are sold than purchased. Short squeeze. A short squeeze occurs when a stock moves sharply higher, prompting traders who bet its price would fall to buy it to avoid greater losses. Sigma. Sigma is a statistical measurement of variability, showing how much variation exists from a statistical average. Sigma measures how far an observed data deviates from the mean or average. Investors use standard deviation to gauge expected volatility, which is known as historical volatility. Specialist. At one time, a specialist was the term used by the New York Stock Exchange, NYSE, to refer to a member of the exchange who acted as the market maker to facilitate the trading of a given stock. The NYSE now refers to these individuals as designated market makers, DMM. Speculator. A trader who hopes to profit from a specific directional move in an underlying contract. Speed. The sensitivity of an options gamma to a change in the underlying price. Split strike conversion. A bullish split strike synthetic position consists of one long call with a higher strike price and one short put with a lower strike price. Both options have the same underlying stock and the same expiration date, but they have different strike prices. Spread. A spread option is a derivative based on the value of the difference, or spread, between the prices of two or more assets. Stock type settlement. A settlement procedure in which the purchase of a contract requires full and immediate payment by the buyer or seller. All profits or losses from the trade are unrealized until the position is liquidated. Stop limit order. A stop limit order is a conditional trade over a set time frame that combines features of stop with those of a limit order and is used to mitigate risk. Stop loss order. Stop loss orders specify that a security is to be bought or sold at market when it reaches a predetermined price known as the stop price. Straddle. An options straddle involves buying, or selling, both a call and a put with the same strike price and expiration on the same underlying asset. A long straddle pays off when volatility increases and the price of the underlying moves by a large amount, but it doesn't matter whether it's to the upside or the downside. Strangle. A strangle is a popular options strategy that involves holding both a call and a put on the same underlying asset. It yields a profit if the asset's price moves dramatically either up or down. Strap. Strap is an options strategy that uses one put and two calls with the same strike and expiration to profit on expectations of a large bullish move. Strike price, or strike. Strike price is the price at which the underlying security in an options contract can be bought or sold, exercised. Strip. A strip option trading strategy involves simultaneously holding long positions in both call and put options with the same strike price, and it is considered market neutral because it is not dependent on the direction of the underlying asset's price. Swap. A swap is a derivative contract through which two parties exchange the cash flows or liabilities from two different financial instruments. Swaption. A swaption, also known as a swap option, is an option contract that grants its holder the right but not the obligation to enter into a predetermined swap contract. In return for the right, the holder of the swaption must pay a premium to the issuer of the contract. Synthetic. Synthetic is the term given to financial instruments that are engineered to simulate other instruments while altering key characteristics. Synthetic call. A synthetic call is an options strategy where an investor, holding a long position, purchases a put on the same stock to mimic a call option. Synthetic put. A synthetic put is an options strategy that combines a short stock position with a long call option on that same stock to mimic a long put option. Synthetic underlying. A synthetic underlying position is an equivalent position that is constructed without actually buying or selling the underlying security. Instead, call and put options are purchased and sold simultaneously. Tau. The absolute change in option price in response to a percentage point change in volatility. Tau is used by traders to capture the sensitivity of option value to a change in implied volatility. For example, a tau of 0.85 indicates an absolute increase in the option's theoretical value by 0.85 if volatility edges up by a percentage of 1.0. Likewise, it indicates an absolute decrease in the option's theoretical value by 0.85 if volatility falls by a percentage of 1.0. Theoretical value. The theoretical value of an option is an estimate of what an option should be worth using all known inputs. In other words, option pricing models provide us a fair value of an option. Theta. Theta measures the rate of decline in the value of an option due to the passage of time. Three-way. A position similar to a conversion or reversal but where the long or short position in the underlying instrument has been replaced with a very deeply in the money call or put. Time box. A diagonal spread is an options strategy that involves buying, selling, a call, put, option at one strike price and one expiration and selling, buying, a second call, put, at a different strike price and expiration. Time premium. Time premium, also called time value, the amount by which an option price exceeds its intrinsic value. The value of an option beyond its current exercise value representing the option holder's control until expiration, the risk of the underlying asset, and the riskless return. Time spread. In finance, a calendar spread, also called a time spread or horizontal spread, is a spread trade involving the simultaneous purchase of futures or options expiring on a particular date and the sale of the same instrument expiring on another date. These individual purchases, known as the legs of the spread, vary only in expiration date. They are based on the same underlying market and strike price. The usual case involves the purchase of futures or options expiring in a more distant month, the far leg, and the sale of futures or options in a more nearby month, the near leg. Time value. The time value of option is the sum by which the option's premium exceeds its intrinsic value. It represents the potential for the option to increase in value due to the passage of time, changes in the underlying asset's price, or changes in market conditions. Type. The designation of an option is either a call or a put. Underlying. An underlying security is a stock or bond on which derivative instruments, such as futures, ETFs, and options, are based. Vanilla option. A vanilla option gives the holder the right to buy or sell an underlying asset at a predetermined price within a given time frame. VANA. VANA is a second-order derivative that measures the change in delta for any change in the implied volatility of an option. It is measured as the change in delta for every 1% change in implied volatility. In options trading, VANA will be negative for put options and positive for call options. Variation. The daily cash flow resulting from changes in the settlement price of a future contract. Vega. Vega is a measurement of an option's sensitivity to changes in the volatility of the underlying asset. Vertical spread. A vertical spread involves the simultaneous buying and selling of options of the same type, i.e., either puts or calls, and expiry, but at different strike prices. The term vertical comes from the position of the strike prices. Volatility. Volatility measures how much the price of a security, derivative, or index fluctuates. Volatility skew. The volatility skew is the difference in implied volatility, between out-of-the-money options, at-the-money options, and in-the-money options. Volatility smile. A volatility smile is a U-shaped pattern that develops when an option's implied volatility is plotted against varying strike prices. Volga. Volga or volatility gamma determines the rate of change in Vega on account of a unit change in volatility. The same relationship convexity has with duration and gamma has with delta. VMA. VMA is the rate at which the Vega of an option will react to volatility in the market. Warrant. Warrants and call options are both types of securities contracts. A warrant gives the holder the right, but not the obligation, to buy common shares of stock directly from the company at a fixed price for a predefined time period. Writing an option refers to selling an options contract in which a fee, or premium, is collected by the writer in exchange for the right to buy or sell shares at a future price and date. Zero-cost collar. A zero-cost collar is an options strategy used to lock in a gain by buying an out-of-the-money, OTM, put and selling a same-priced OTM call. Zama. Zama is a measure of the degree to which the gamma of a derivative is sensitive to changes in implied volatility. It is also known as gamadvol.